Welcome to this explainer. Today we're completely tearing down the illusion of quote-unquote safe investments here in India. We are going to explore a financial trap that catches literally millions of households every single day. And we're going to do it by looking at the hard, undeniable facts. So let's get right into it.
Okay, let's dive into this with a little case study. Picture two friends living in the same town. They share the exact same ambitions, the same drive to secure their financial futures. Now, they both know they need to save, but as you'll see in a minute, their choices are entirely different. So, the big question is, who actually builds better wealth over a 5-year period?
To make this a totally fair comparison, let's look at their starting line. Both of our friends, let's call them Arjun and Karthik, earn the exact same monthly salary of 40,000 rupees. Their starting point is identical. Every single month, they have the exact same resources at their disposal. The difference in where they end up isn't going to be about how much they make. It's all about how they deploy what they actually keep.
So let's break down their profiles. On one side, we have Arjun. He's highly disciplined, but man, he is heavily risk-averse. He wants zero market tension. So he locks 5,000 rupees every month into a 5-year post office recurring deposit. On the other side is Karthik. He wants slightly higher returns and a bit more flexibility. Since he has a lump sum ready to go, he parks 3 lakh rupees into a private bank fixed deposit for that exact same 5-year tenure.
Section 1. Arjun's Path, the Post Office RD.
So Arjun confidently chose the post office. And I get it. It offers the ultimate peace of mind, right? You get government-backed safety and a totally predictable maturity amount. But look at the trade-off here. The wealth growth is just painfully slow. There are strict penalties if he needs to withdraw early, and to top it off, the interest is fully taxable. Arjun slept peacefully, completely free of market anxiety, sure, but his money was practically standing still.
Section 2. Karthik's Path, the Bank FD.
Now, Karthik took a slightly different route. He preferred the modern flexibility of a private bank. His FD gives him easy online access, stable returns, and honestly, much better liquidity than Arjun's RD. But the negatives are glaring. Taxes take a really heavy bite out of his real profit, and more importantly, those fixed returns become remarkably weak when the cost of living inevitably goes up. Karthik felt incredibly smart about his flexible setup, entirely ignoring a massive, silent threat lurking right in the background.
Okay, fast forward 5 years. The maturity date finally arrives. Both friends eagerly check their accounts. Arjun sees his disciplined savings have grown steadily. Karthik sees his lump sum has earned a slightly higher amount, thanks to the bank's promotional rates. Both absolute numbers went up. They high-five, they celebrate their financial prudence, and they feel like absolute winners. But here is where we really need to take a step back.
Right at this peak moment of celebration, let's say an older, wiser mentor steps into the picture. He looks at their bank statements, nods, and then asks them one vital question that just stops them dead in their tracks. Can your returns beat inflation? Both Arjun and Karthik are just entirely confused. I mean, they saw the numbers go up, right? So what in the world does inflation have to do with their success?
So the absolutely crucial point here is a concept called real wealth growth. It is not about the absolute number sitting in your bank account. It's about the actual increase in your purchasing power. You calculate it by taking your investment returns and subtracting the rate of inflation. Think about it like this. If inflation is running at 6% and your FD earns exactly 6%, your real wealth growth is 0. You literally haven't moved forward a single inch.
And this brilliantly illustrates the problem. Over those 5 years, the real world didn't just stand still. A simple cup of tea that used to cost 10 rupees now costs 18. That is an 80% jump. And obviously, it wasn't just tea. Petrol, school fees, medical expenses, they all practically doubled. The fundamental cost of just existing surged forward.
Which brings us to this incredibly harsh, inescapable reality. Your money may grow in numbers, but lose purchasing power. This right here is the invisible enemy. Traditional safe banking products create this really dangerous illusion of safety. You never see a negative sign on your bank statement, but quietly, day by day, inflation is just stealing the real value of your capital.
Section 3. The Mentor's Playbook, the Smart Wealth Strategy.
Once Arjun and Karthik realized their investments were actually losing to inflation, the mentor opened up a totally new playbook for them. His core philosophy is actually remarkably simple. Step 1, protect your money. Step 2, build your wealth. You absolutely cannot use the same tool for both jobs. Mixing them up is exactly where most people fail against inflation. Now let's be super clear about something.
RDs and FDs are not useless. Not at all. They are highly specific tools. You use a post office RD for disciplined monthly savings, or a bank FD to park a lump sum securely. They're built for emergency funds, short-term goals, and absolute unbreakable stability. They are the foundation of your safety net. But that's it, nothing more.
But for actual wealth creation, you've got to bring in the heavy lifters. This is where you use growth investments, mutual funds, index funds, systematic investment plans, and PPF. These are the assets that are mathematically designed to aggressively fight back against that invisible enemy. Combining your safety net with these growth tools is how you consistently outpace inflation.
So, let's check back in on our friends 5 years after that wake-up call with a mentor. Arjun still uses an RD for his savings discipline. Karthik still keeps an FD for stability. But now, both of them channel their surplus cash into long-term growth assets. The final verdict? The ultimate winner in our original story wasn't Arjun and it wasn't Karthik. The real winner is the evolved investor, the person who understands inflation, respects it, and builds a combined portfolio that both protects today and grows tomorrow.
And that brings us right back to you. Take a really hard look at where your money is sitting right now. Ask yourself honestly, is your current portfolio just protecting your money while quietly losing its purchasing power every single day? Or is it actually structured to build your wealth and defeat inflation? It might be time to rewrite your own playbook. Thanks for joining me on this explainer, and I'll catch you next time.